Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be answering the question, what is a fiduciary financial advisor? Most entrepreneurs and families worry about money, so we created the Wisdometric framework to help you eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. When it comes to a fiduciary financial advisor, we have to start with the word fiduciary because fiduciary is not only for financial advisors. A fiduciary is someone who is obligated, or is either a person or a firm, and they're obligated to do what is in your best interest as the client. That is going to be something that is super important when it comes to making any decision whenever possible, but especially when it comes to your finances. And you may be asking, okay, well, if a fiduciary is someone who is required to do something in my best interest, like who requires them? Which is an excellent question. The requirement comes from the SEC, whether that is going to be someone who has like a firm that's federal, or it could be your state regulators if you have a firm that is registered within a certain state. And basically what happens is, by law, if you so for example, if I made a trade for myself, like let's say I called you up and I was like, oh, I really love this stock and I bought it for you and I bought it for me. And I just, did it in whatever order. So I maybe bought it for me and then I called you, or I called you first, but it took you a while to get back to me. So I bought mine while I was waiting on you to confirm yours. However that worked out, what would ultimately end up happening is whichever of those trades ends up being the better trade, I would have to give that trade to you. So it becomes a situation where even if it wasn't intended to be something that benefited me over you, I would still act in the same manner where I have to do what's in your best interest. And clearly, if I bought the stocks at one price and I bought them at another price, giving them to you at whatever that best price is would be in your best interest. Now, at the same time, some of you may be saying, well, even though that's great, I don't really need that much of a commitment from you, which is fine if you feel that way. The other aspect of a fiduciary is they're not going to have a conflict of interest, or at least they should tell you up front, and they should work to minimize the conflicts of interest. So some of those has to do with the way a financial advisor gets paid. And we have found the best way to limit the conflicts of interest as much as possible is for us to have a fee-only arrangement that where we get paid based on our advice and not based on your particular investments. As a result, we are able to say whether it makes the most sense for you to take your money out of the stock market and put it in the real estate, take it out of real estate and put it in your business, or whether it makes the most sense to take the money out of the stocks and to take a family trip where you bought cruise tickets for your entire family to be able to take like a family reunion type of a trip together. Right? We are able to have those discussions, and whatever is in your best interest, it doesn't really change the way that we get paid. So it does have that limiting of the conflicts of interest. Now, most commonly, you're going to find that most financial advisors that are fiduciaries get paid in the AUM model, which is the assets under management. Now, again, having a conflict of interest doesn't mean that they're going to, succumb to their conflicts. It just means that they have conflicts there and that they would be letting you know ahead of time to make sure that you're aware so that you can make an informed decision. So you may be asking, okay, Dre, I can sort of see maybe what some of the benefits of a fiduciary financial advisor would be, but what is the other option available? If you're not a fiduciary, then what standard are you operating under? Which would be another excellent question. So if you are a fiduciary financial advisor, then you are going to be making sure that any investment recommendation, or really any financial recommendation, any financial advice that you give is going to be the best advice for that particular client, that it's in their best interest based on their goals, needs, risk tolerance, and time horizon. And so then you're going to make a financial plan that is based on that particular person and their needs. If you are not a fiduciary, then you are held to what's called the suitability standard. And suitability just means it has to make sense, generally speaking, for someone who's of a particular age with a particular need. And so suitability just means that it has to make sense for the large of the population. And so it really makes sense for someone who's in their 20s to have very aggressive investments, because generally people retire at 65. That would be a suitable investment. But if you were making a financial plan for someone and you found out that they wanted this money or they needed this money a little for maybe something a little bit different, like a business, or maybe to a down payment on a home, or something that adjusts their overall needs and time horizon, then you can make different recommendations based on their particular needs. And it doesn't mean that those two are going to be different, but they could be. And so whenever you're dealing with suitability, it just means that it makes sense for maybe like a 30-year-old to have this type of a plan. It makes sense for someone who's 60, generally speaking, to have this type of plan. But is it what makes the most sense for you? Is it what's in your best interest with your goals and your needs and your family dynamics? Is it specific to you? And suitability doesn't always meet that standard. And sometimes it's difficult for suitability because more times than not, that's where you're going to be dealing with people who are paid commissions. And if your financial advisor is paid a commission, then it's sort of baked into the cake that they have a conflict of interest because they're going to be paid different commissions based on the different products that they recommend. If they are being paid more for recommending an annuity and they're being paid little to nothing for recommending stocks, or if they're being paid, like let's say there's like this promotion that's going on with their broker, and so it makes sense for them to be able to, rack up a certain type of a product sale because they're going to get paid, out these bonuses or this amazing trip to Puerto Rico. Well, from a suitability standpoint, that is not wrong, right? There's nothing wrong with that because they're making general recommendations that make sense for someone who has a similar situation as you. Versus the fiduciary standard, you wouldn't be able to make those same recommendations because it's not about whether it generally makes sense for someone. Because of the fee structures and all these trips and all this stuff that's going on, they would be required and obligated to find you something that would get you the same return, but at a much lower cost to you. And so it really becomes much more beneficial to work with a fiduciary financial advisor. If you have any additional questions about retirement planning, I invite you to check out my free retirement planning that works video training at obsidianwisdom.com/training. In it, I give you the entire wisdometric framework that I use with my clients to help them eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. Until next time, Wisdomites, remember, wisdom is asking the right questions to allow yourself to get the right answers. Keep asking those questions and you will keep getting those answers. Continue blessings.